Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to The Investor's Edge. First up, the week in review. Bank turmoil continues. Well, it's been less than 2 months since the failures of Silicon Valley and Signature banks, which at the time were the second and third largest bank failures in U.S. history. This past week, however, First Republic Bank was seized by the FDIC and immediately sold to JPMorgan, which moved it into second place for the largest bank failures of all time. Not exactly a list you want to be at the top of. But as the week wore on, PacWest became the next bank on failure watch, with its stock plunging more than 70% in just a few days. Western Alliance looks like it could be heading in a similar direction as well. Now, it's hard not to notice that all these banks are either based on the West Coast or had substantial exposure there in the case of Signature. So combining the rapid rise of interest rates with poor asset liability management and challenges in the land of tech startups and venture capital has produced a toxic environment for these banks. Now, a big problem seems to be that once a bank is branded as a potential problem in the financial media, their demise kind of becomes a self-fulfilling prophecy as it causes more deposits to flee, raises funding costs, and encourages the top talent to seek other opportunities. At some point, the remaining banks will be made stronger after culling the herd of its weakest members. But in the meantime, there may be still a few more shoes to drop before all is said and done. For this week's featured insight, in markets, ignorance is not bliss. So investing in publicly traded securities is difficult, of course, in large part because of the minute-by-minute pricing updates made available to us through modern technology. Knowing what your portfolio is worth every second of the day can create strong emotional responses that lead to bad decision making. And while I always encourage investors to think long term and avoid checking their portfolio value every single day, there are investment products that have taken advantage of investors' desire to not experience price volatility. Many of these so-called non-traded investments claim to be safer or produce better returns than traditional investments. But there is no free lunch. Since some of these investment vehicles update their market values very infrequently, in some cases years, you may not realize if the value of the underlying assets is deteriorating in value. So be careful to understand the details of any investment that doesn't have a readily available market value. Because in this case at least, ignorance is definitely not bliss. Looking ahead, sell in May? Well, there's an old market adage that says, sell in May and go away, referring to the seasonal anomaly that there tends to be below average stock market performance between May and September. So with all the things to worry about, bank failures, Fed raising interest rates, recession predictions, debt ceiling, I could go on and on. Why wouldn't it make sense to take the summer off from market volatility? Well, for one, the market loves to surprise people. If everyone is thinking the same way, in this case fairly negatively, it becomes more likely that the outcome will actually be the opposite of what most people think it will be. While there's obviously the possibility of more market volatility in the months ahead, you shouldn't let old wives' tales or clever-sounding phrases that rhyme deter you from your long-term investing plans. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.